This is Your Money, Your Wealth.
Welcome to another edition of Your Money, Your Wealth. Joe Anderson here, certified financial planner, president of Pure Financial Advisors. I'm with the big man, as always, Big Al Clopine. He's sitting right over there. We're seeing some volatility in the overall markets. Are you making any mistakes with your money? Odds are you probably are. Stick around the next half hour. We're going to talk about the most common mistakes that you are making with your money when it comes to your investments, and what are some steps that you can do to avoid the most common mistakes, because the problem is you don't even know that you're making the mistakes. That's what's on my mind today. If you're in retirement or close to retirement, stock markets get volatile and you get scared and you do things that you shouldn't do with your money. A lot of mistakes happen, and it's understandable because we're emotional people, especially when it comes to your money. What I want to get into today is to figure out a very systematic way to manage your money, to take a look at what the academics say, to make sure that you have a solid process. Because when markets do get volatile, there's opportunity, but are you taking advantage of that opportunity? To join in the discussion, let's bring in the big man, Big Al Clopine. You know, when you're looking at investing now, when markets get volatile, that's where a lot of mistakes happen. And let's dive in and figure out, well, what are some of the top mistakes that people are doing, and some ideas that we can help them negate those?
Well, there's no question, Joe, that people are making a lot of mistakes, not just now, but almost in every market, but especially today, especially with markets at all-time highs. People are making these mistakes, and if you just know what the mistakes are, you'll have much less chance to be making them. So let's get into the top 5 that we're going to talk about today. There's actually so many. We're going to do another show next week for the other 5. But the first one I want to talk about is information overload. And I think we've got a clip to illustrate that.
Now, meantime, let's talk IPOs. This is going to be a huge week.
We do have an opening trade on La Quinta over at Post State. Looks like
I think this is the window closing. We've had enough deals. These bankers are trying to jam them in. I think the appetite is waning.
The parade continues. iKing has just opened at the NASDAQ.
How can you make any sense of that? It's almost impossible. But we try to. We watch this over and over again. And we tend to pick 1 or 2 experts that we like, and we start believing the hype, and we start investing the wrong way. So information overload is number 1. Number 2 is believing the hype. It's not a good way to invest. And that causes us to do market timing, which you would think, all right, let's try to sell high and buy low. That makes sense, right? But academic studies for the last 50, 60 years would tell us it's impossible or almost impossible to time the market. There's really a better way to do it. And then the chasing returns, when you take a look at what's done well over the last year or 2, that's not necessarily what's going to do well in the future. And then finally, a lot of us are trading a lot, excessive trades. And what that means is that we're buying and selling, buying and selling. Not only is that causing us to spend a lot of money, because every time we trade, Wall Street takes some of our money. But if it's a taxable account, there's short-term gains, which are highly taxed. So, Joe, we're going to get into these 5 today a little bit more, because I think if people just knew what these mistakes were, they wouldn't make them as much.
Yeah, you're absolutely right, Al. And so when you take a look at information itself, so here's a quick drawing to help you understand what we're talking about. There's a ton of information, all right? So we call this noise, right? You just saw that clip from CNBC. There's talking heads. One person's saying one thing, some person is saying the exact opposite. That is what we call noise. Ignore that. Then you have a little bit of information that you can hear, but a dot, see that little dot down there? That's the only thing that's useful. That's it. And so how do you decipher from all of the noise that is out there to figure out exactly what nuggets should you grab to make good investment decisions? It's extremely, extremely impossible. Then you take a look at this, right? So CNBC, you have a guru. So let's put a little top hat on this person here. So that's a person that knows the markets. He's got the crystal ball, or she's got the crystal ball. And by the way, these people make billions of dollars on Wall Street. Okay, it's taking money from us. So then they take that, and then here's your money, right? So you're going to give your hard-earned money to these gurus, okay? You know what that equation, oh, this should be a plus sign. You know what this equals? Who knows what's going to happen? It's a crapshoot. Let's go to this video so I can prove my point exactly.
We haven't heard a thing from CNBC, although Jim Cramer did write an article for MainStreet.com complaining that we had unfairly used a video clip out of context to make it look like he recommended buying Bear Stearns stock a week before it collapsed. Okay, I was wrong. Actually, it's true. He wasn't saying to buy Bear Stearns. He was simply saying that if Bear was your broker or that your money was at Bear, your money would not disappear. He was not addressing the value of holding Bear stock. So, Jim Cramer, I apologize. That was out of context. Technically, you were correct. You weren't suggesting to buy Bear Stearns. That was something that you did 5 days earlier in your buy or sell segment.
I believe in the Bear franchise. You know what? It's 69 bucks. I'm not giving up on this thing.
Yeah! Of course, while Cramer wasn't giving up on Bear at 69, 11 days later, the stock market was more comfortable with it at 2. But it's all sort of equivocal. You know, I'm reiterating, I like Bear at 60s, I like Bear in 70s. He's not saying literally, I'm asking you to buy Bear Stearns. For that, you'd have to go back a full 7 weeks before the stock completely collapsed.
I'm asking people who are watching this video to buy Bear Stearns.
So if you take a look, Al, I mean, Jim Cramer is an extremely intelligent individual.
No question.
All of these when you look at portfolio manager, hedge fund managers, people on Wall Street, we're not taking away their intelligence because they are very smart. I mean, he made a bad call, an extremely bad call. Our point is that you can't put your hard-earned retirement dollars to someone's gut feeling or their hunch or what they think that's going to happen in the overall markets, because no one has a crystal ball. No one really knows exactly what's going to happen in the future. So that's the problem with people investing. They listen to the hype, they listen to the noise, and then there's information overload, Al, that is just incredible. And then when things get volatile, emotions get high, and then that's when people make rash decisions.
Well, it is, and I actually just saw a study recently, which was for Jim Cramer, how he really did in 2011 and in 2012, and they looked at his picks. It was 500-some picks, and they took a look and say, well, how did he do relative to just the S&P index? And he was at 46% success rate, which means that 46% beat the index, 54% didn't even match the index. You could be throwing darts and doing better.
What's a 50% shot, Al? If I'm going to pick one stock, it's either going to go up or down, right?
That's right.
You're 46%, so, I mean, that's where you have to take a look at the odds and what you're trying to do. So when we get back from the break, I'm going to bring in an expert, Bobby Gavari. He runs the institutional channel for Pure Financial Advisors. I want to pick his brain a little bit on what you should do with your money. But here's a gift from us to you. If you want us to take a look at your overall portfolio to make sure that you're doing everything correctly, managing your assets towards your particular goals, we're giving away a free portfolio review. Here's the number, 888-994-6257. That's 888-994-6257. I think it's right there on your screen. Pick up the phone, call right now. It's absolutely free. Got a lot more to go. Don't go anywhere. Show's called Your Money and It's Your Wealth.